Hey folks, welcome back to the channel. We're halfway through February, so let's check in on the economy and try to figure out where the markets might go for the rest of this month. In Canada, one of the largest retailers, Canadian Tire, had earnings out last week, and it was a pretty big disappointment, both in terms of revenue and profits, with a negative downside surprise. Comparable sales were down 6.8% compared to this time last year, and normalized earnings per share ended up being down 45% year over year. Now, that's a pretty big decline, which partly explains the low opening on Thursday, which the stock hasn't been down to 129 for, well, you have to go back all the way to 2020. So that is a clear sign that the economy in Canada is not doing so well. And if you just look at the chart of Canadian Tire, you can see it's on this downward channel. And probably the reason it did not go even lower on Thursday was because it found support on the bottom of this bear channel. Now, Canadian Tire is a discretionary stock, so it makes sense that when consumers have less money to spend, they cut back on this kind of stuff first. But the real barometer of how potentially bad an economy is consumer staples and things like food. Because when consumers start to cut back on the essential things you need to survive, then that's when it starts to really feel like a recession. So the largest retailer in Canada with tens of billions of dollars in revenue each year is Loblaws, the parent company of Superstore, and they sell a lot of food and staples that people need. As you can see, the stock has had a pretty good run looking at the daily chart, with this really big move starting from October of last year, which was pretty much when the market overall bottomed, and it's been up about 24.5% so far. But it's going to release earnings this upcoming week on Thursday with an estimated revenue of $14.5 billion and expected profit of $1.9. Now, one thing to look out for is, of course, whether or not it meets these expectations, but the other thing is year-over-year growth. Nominal growth is not enough because there's inflation to consider and there's also more people coming into the country. So if we want to figure out if people are spending more money or less money at Loblaws, which owns all of these stores, and if we want to look at a per person spending, then we have to consider that there are more people now shopping at these stores and the price of food in general has gone up. Now, in terms of inflation, the CPI was 3.9%, but if we look at food, which is most of what people buy at this chain of supermarkets, then that's actually up a lot more. Last year, the lowest inflation rate for food was in November and December at 5%, but at the beginning of the year, it was at 10.4%. So if you take an average of 2023 last year, food inflation was probably around 6 or 7%, maybe a little higher. And in terms of population growth, the government has let in about 1 million people per year over the last couple of years, and the country has a population of 40 million, so that's about a 2.5% increase in total population. So this means if we take inflation, say at 6.5, and population growth at 2.5, and we add them together, we have to expect that year over year, Loblaws' revenue should increase at least 9% if consumer spending habits don't change. And that's a pretty high hurdle. If the revenue growth comes in lower at, let's say, 5%, then that means each household is getting less food than the previous year. So if the numbers come in good, then maybe the economy will continue to stay resilient. But if sales growth is lower than 9%, then that means consumers are actively cutting back on things that they would have bought a year ago, but they're spending less now, maybe because they have less money to spend or they are more financially worried and are trying to save more money. And if that is the case, then that's not good for the economy going into the next few quarters because less consumer spending usually means lower GDP. And speaking of saving money, if we look at the US now, one thing I'm keeping an eye on this week and potentially for the rest of the month, is Americans' excess savings since the pandemic. As you can see in 2021, because of government stimulus, people saved a lot of money and they kept it in their bank accounts. But ever since the financial markets started to tighten in 2022, people have been drawing down their savings. And as of the end of last year, there were just $2 billion left, so about a tenth of the original excess savings that people had. Now, if we extrapolate this curve, this line here that's going down, which looks pretty straight, then it looks like by about, actually right now, in the middle of February, is when people are going to run out of money. Now, it's just a guess because we don't have the data yet, but just going by the rate at which Americans are spending their excess savings, it looks like mid February to the end of February is when the excess savings will reach zero. So, when that happens, it'll be a drag on the economy because people are spending less since they can't use their savings anymore to buy stuff. And that's going to affect business revenue and the financial markets and all of that stuff. So, looking at the US stock market, we'll just look at the S&P 500. It's had a pretty good run since the back in October, and year to date it's up about 7%, which is really good since it's only been a month and a half. But if we look at the seasonality of how the stock market tends to behave on average over a 20-year period, you can see that from the middle of February to about 1 or 2 weeks into March, the market tends to be fairly bearish. So I wouldn't be surprised if we get a pullback over the next couple of weeks in the market. Now, the one thing that could make the stock market deviate from this historical pattern is if Nvidia has a absolutely banger of an earnings report, because they are coming out with earnings on Wednesday afternoon. So that is definitely something to keep an eye on, because if Nvidia misses or they don't even have to miss, but if the stock falls, then it will likely take the rest of the S&P 500 with it. On the other hand, if it's not too bad, then the stock market could go up a little bit higher because the technicals right now are still showing very bullish for the stock market. Despite that, seasonality wise, it's right about now that the market starts to go down for 2, 3, or 4 weeks. So those are just a few things to keep in mind. If I see Nvidia's earning miss, I might buy some puts on the S&P 500 on the index, as we'll likely see some kind of pullback. But overall, long term, I am still long the market. In any case, thanks a lot for watching. Good luck with your investments, and until next time.